Most people think the tax magic in real estate happens when you buy the property. That is where the fantasy begins. They see wealthy investors buying apartment buildings, warehouses, duplexes, little shopping centers, and short-term rentals. And it all looks effortless from the outside. Every deal seems to come with a deduction. Every new purchase sounds like a win against the IRS. Every podcast, every social clip, every dinner table conversation turns into the same lazy story. Buy real estate, write it off, get rich, pay less tax. But I have been around money long enough to know that what looks simple from the outside is usually where ordinary people get hurt. The public tends to notice the front end of a strategy and ignore the back end. They notice the refund, they ignore the recapture, they notice the deduction, they ignore the trigger, they notice the smiling investor holding keys in front of a camera, they ignore the silent arithmetic waiting years later when the property is sold, transferred, distributed, refinanced badly, or pushed through the wrong structure. And in real estate, one of the costliest misunderstandings in America is this one. People think they created a permanent tax victory when in reality they only delayed a very real tax bill. In some cases, they made that bill larger, much larger. That is the first thing I want you to understand if you expect to buy a house or an investment property in the next 5 years. Real estate can be a wonderful wealth-building machine. It can also be a beautiful-looking trap for people who understand deductions but do not understand consequences. There is one decision that quietly determines whether you are building a long-term tax advantage or merely borrowing time from the government at terms you do not understand. Most people never realize they made that decision. They think the important moment was the purchase. Very often, the important moment was the moment they set in motion a future taxable event they have no plan to control. That is where fortunes separate. The amateur asks, how much can I write off this year? The serious investor asks, what exactly will cause the IRS to come back for this benefit later, at what rate, and under what structure? Those are not the same question. And if you get that distinction wrong, the property that looked like a tax shelter turns into a tax ambush. I have watched generations of investors make the same mistake in different costumes. Some did it with rentals, some with family partnerships, some with corporations they did not understand, some with aggressive depreciation, some with cost segregation studies that made them feel clever on the front end and miserable on the back end. The names change, the buildings change, the software changes, human nature does not. People love an immediate reward. They hate delayed consequences. That is why real estate confuses so many otherwise rational people. It rewards you early. It flatters you early. It hands you paper losses, deductions, and depreciation while your ego is still warm from the purchase. It lets you feel like you beat the system before the system has finished the ledger. Then years later, the hidden half of the transaction shows up. And if you were not planning for that day from the beginning, the tax law stops looking like a playground and starts looking like a debt collector with perfect memory. So let me walk you through this the way I would explain it to somebody sitting across from me who wanted the truth instead of the sales pitch. There are really 3 moving parts here. First, the trigger. Second, the tax bill that appears after the trigger. Third, the structure that serious investors use to avoid turning temporary tax relief into a permanent mistake. If you understand how those 3 pieces fit together, you stop copying the appearance of wealthy real estate investors and start understanding the machinery they are actually optimizing. That is where the edge lives. Let us begin with the trigger, because this is the part that fools the most people. Most people are taught to think about real estate in a straight line. Buy a property, hold it, let it appreciate. Take deductions while you own it. Sell it later for a gain, end of story. That is a child's drawing of a machine. The real machine is more complicated. The tax code does not simply care that you owned a property. It cares about events. It cares about recognition. It cares about whether a gain has been realized, whether a deduction has already been claimed, whether basis has been reduced, whether value has been moved, and whether you crossed a line that causes the government to say, now we settle up. That line is the thing most people fail to respect. A taxable event sounds abstract until it lands on your return. Then it becomes painfully concrete. People will say, I bought a property, I ran a cost seg, I took huge depreciation, and I saved a fortune, maybe for that year. But that sentence usually carries a hidden assumption. The assumption is that the tax advantage belongs to you permanently. Often it does not. Often it belongs to the timeline. Often it belongs to the structure. Often it belongs to the condition that you do not trigger recognition in the wrong way at the wrong time. Real estate is frequently a tax deferral strategy before it is a permanent tax saving strategy. That one sentence can save a buyer years of confusion. Deferral is not the same as elimination. Delay is not the same as escape. A property purchase can reduce taxable income today and still create a larger reckoning later. The reason is simple. The tax system keeps score. Your basis changes, your depreciation accumulates, your paper savings are recorded, and when the property is sold, distributed, or otherwise triggers recognition, the government does not forget the benefits you already took. It reconciles them. That is the word people need to fear a little more. Reconcile. Every depreciation deduction that felt painless on the way down gets pulled back into the conversation on the way out. Every write-off that made the property feel magical becomes part of the future arithmetic. The tax code is not sentimental, it is chronological. If you bought a property for one amount, improved it, depreciated it, reduced your basis, and later sell it at a higher value, the government is not merely asking what you sold it for, it is asking what your adjusted basis became after everything you claimed along the way. That is where the trap opens. A person who thinks only in terms of purchase price and sale price is usually missing the entire middle of the story. And the middle is where most of the tax history was written. This is why I say the fatal decision is often invisible when it is made. The buyer thinks the important act was taking the deduction. The real decision was taking the deduction without designing a path for the exit. That is like celebrating the smooth takeoff and forgetting that airplanes eventually need a runway on the other end. If the exit is unmanaged, the property that looked like a tax gift becomes a tax trigger. Now let us move to the second part, because this is where reality becomes arithmetic. Once the taxable event occurs, people finally meet the bill they spent years quietly building. And what shocks them is not that there is tax. What shocks them is that there may be more than one layer of it. This is where real estate investors who only understood the slogan get separated from investors who understood the structure. Every year you claim depreciation, you lower current taxable income on paper. That feels good. It should, the system allows it. Depreciation is real, but the benefit is not detached from time. It sits there in the background, reducing basis, waiting for the day the asset is sold or otherwise recognized. Then the IRS starts adding the story back together. First comes depreciation recapture. That phrase is boring enough that many people ignore it until it becomes expensive enough that they can no longer ignore it. The deductions do not simply vanish into the past. The government generally wants to tax part of that benefit back in ordinary real estate. That often shows up as unrecovered Section 1250 gain taxed at rates up to 25%. Then on top of that, you may still have capital gain on the appreciation above your original cost and adjusted basis. So now you are not dealing with one tax idea. You are dealing with layers. One layer asks, what tax benefit did you already consume through depreciation? The other asks, how much actual economic appreciation exists above your adjusted basis? Those layers stack. That is why investors who believed they were harvesting a clean and permanent advantage discover that the machine was merely shifting when and how the tax would appear, and sometimes they make it worse. Let us talk about the move that creates the most false confidence: cost segregation. I have no objection to the tool itself. Used correctly, with intelligence, it can be useful. Used blindly, it becomes a trap disguised as sophistication. What cost segregation often does is accelerate depreciation by reclassifying parts of the property into shorter life assets. On the front end, that can produce bigger deductions sooner. People love that. They post about it. They brag about it. They talk as if the tax law handed them free money. But character matters. If you convert pieces of the property into categories that later recapture at ordinary income rates rather than the lower rate many people had in mind, then the same front-end victory can produce a nastier back-end outcome. That is where surface-level advice becomes dangerous. Suppose accelerated depreciation gives you $240,000 of additional deductions. If that amount stayed in a bucket recaptured at 25%, you might picture one outcome. If the character shifts and that same amount later recaptures at ordinary income rates that can reach 37%, the tax bill changes in a way that many people never bothered to model. A move that felt brilliant in year one can cost tens of thousands more when the property is sold. And the saddest part is that the investor often still tells himself he won because he remembers the deduction and emotionally discounts the later bill. People do this constantly in finance. They overvalue an immediate visible gain and undervalue a delayed invisible cost. That is not a tax problem. That is a human problem. The world is full of people who would rather feel smart today than be right over the full life of the investment. The wealthy investor we're studying does not think that way. He does not ask whether a structure made him look clever on this year's return. He asks whether the full life cycle of the asset improves after tax wealth without creating a future forced error. That is a very different mindset, and it leads to a very different system. Now we are ready for the third part, which is the only part that really matters if your goal is to keep more of what you build. Once you understand the trigger and the bill, the intelligent question changes. You stop asking, how do I get the deduction? You start asking, how do I avoid triggering the recognition event in the wrong way at the wrong time, under the wrong conditions? That is the shift from being impressed by tax strategy to actually using tax strategy. The first major tool is the properly executed 1031 exchange. I emphasize properly because the tax code does not reward good intentions. it rewards execution. A 1031 exchange is powerful because it can defer recognition of gain when you dispose of one qualifying property and reinvest into another. No immediate capital gain, no immediate depreciation recapture if the rules are followed. Legally, the gain carries forward into the replacement property rather than being recognized right now. That is elegant. But elegance disappears when discipline disappears. I have seen people sell first, touch the cash, and then ask for help as if the rules might bend out of sympathy. They do not. Once the transaction is blown, it is blown. I have seen people misunderstand the debt replacement requirement and assume that rolling over net cash was enough. It often is not. If you gave up debt in the sale, you generally need to replace it with new debt or additional cash to avoid taxable boot. I have seen people fail to report the exchange properly, as though the tax law were a spiritual force that could be felt without documentation. It is not form, timing, identification, replacement, reporting. If you are sloppy with any of them, the machine can stop behaving the way you imagined. That is why I say a 1031 is not magic. It is disciplined deferral, and disciplined deferral is still only step one. The more sophisticated insight is that the best tax bill is often the one you never trigger at all. This is where the second major strategy enters. Hold the property until death. That sentence makes some people uncomfortable because it reveals how long the serious game is. Many people still think the objective of investing is to buy, juice the deductions, and eventually cash out. That is one way to play. It is not always the best way to compound after taxes. If a property is held until death, the basis generally steps up to fair market value. The deferred gain can disappear for income tax purposes. The built-in appreciation that would have triggered tax on sale can effectively be erased in that transition. The old depreciation history no longer matters in the same way because the asset is no longer carrying the same built in-income tax burden. That is one of the most powerful features in American wealth building. It is also one of the least emotionally appreciated because it requires patience, planning, and a willingness to see real estate not merely as an asset to flip, but as a machine that can produce cash flow, borrowing capacity, and eventual intergenerational transfer. That is how you begin to understand why some wealthy families seem to keep winning with real estate, while outsiders keep wondering where the tax went. The outsiders think the secret was the depreciation. Very often the secret was that the family never voluntarily triggered the event. They kept the asset. They borrowed against it when they needed liquidity. They let time and structure do the work. They understood that realization is optional more often than the public thinks. That is what makes this game so unintuitive. The beginner believes profit is created when you sell. The seasoned investor often understands that after-tax wealth is sometimes preserved precisely by not selling. That brings us to the third leg of the real blueprint: acquire fresh basis with new capital. This is where the whole system starts to feel alive. A person who 1031s one property into another is carrying basis forward. The old tax story still lives inside the new asset. That means you do not necessarily get a full, fresh world of deductions the way a beginner imagines, the gain carried forward, the basis carried forward, the hidden future tax potential carried forward. Sophisticated investors know this. So while they continue deferring old gains through careful exchanges or long holding periods, they often use fresh income, fresh capital, or other cash flow to acquire additional properties with new basis. New basis means new depreciation potential. New depreciation potential means fresh deductions. Fresh deductions arriving while old gain remains deferred can be a beautiful arrangement when it is done intelligently. Now, the investor is not merely recycling tax history, he is stacking it. He is deferring one set of gains while creating new current deductions elsewhere. That is not an accident. That is system design. And system design is what separates a portfolio from a pile of properties. The person who buys one rental after watching 3 videos online may own real estate. The person who understands triggers, basis, recapture, exchange mechanics, holding period strategy, and capital allocation owns a system. That is the identity flip most people need if they plan to buy in the next 5 years. Do not become a house buyer with tax hopes. Become a capital allocator with a tax map. Those are radically different identities. A house buyer sees granite countertops, school districts, rent comps, and mortgage rates. A capital allocator sees basis, depreciation, character, future recognition, risk, financing flexibility, holding period, entity consequences, liquidity options, family transfer goals, and the exact conditions under which the IRS gets paid. I am not telling you to stop caring about the property. I am telling you that the property is only one part of the machine. And if you ignore the rest of the machine because the property makes emotional sense, you may spend years making money and still lose a shocking portion of it at the exact wrong time. There is another layer here that people need to hear. Real estate tax strategy is not about avoiding tax in some cartoonish permanent way. It is about controlling timing, character, and recognition. That is what serious planning does. Timing decides when the bill comes. Character decides how the bill is taxed. Recognition decides whether the bill appears now or later. If you understand those three forces, you stop being surprised. And not being surprised is one of the biggest financial advantages in life. Most expensive mistakes are not caused by ignorance alone. They are caused by false certainty. The buyer is not confused. He is confident. He thinks he knows what the deduction means. He thinks the cost seg made him sophisticated. He thinks appreciation plus write-offs equals an automatic win. He thinks selling later is just the fun part where the check arrives. Then the tax return arrives. Then the recapture is larger than he imagined. Then the capital gain layer shows up. Then the state tax joins the party. Then the structure he used turns out to have consequences he never modeled. Then he discovers that the beautiful front-end story was missing the ending. That is why I want you to think about the next 5 years differently. If you are buying a primary home, the issues may be different in detail from pure investment property. But the principle is the same before you celebrate the visible tax angle of any real estate decision. Ask what future event controls the hidden tax angle. Ask what happens to basis. Ask what happens if you convert use. Ask what happens if you sell sooner than planned. Ask what happens if you place it in the wrong entity. Ask what happens if the market forces your hand before your strategy matures. Ask what happens if the front-end benefit is simply a loan from the future. That question alone can make you a better investor than most of the people giving advice on the subject. Because the real mistake is not paying tax. A healthy society taxes gains. That is not scandalous. The real mistake is believing you achieved a tax advantage when in fact you only postponed or enlarged a tax obligation you never bothered to model. That is the kind of error that does not just cost money. It corrupts judgment, it trains people to chase appearances, and finance punishes people who chase appearances. So here is the protocol I would hand to anyone serious about buying property soon. Before you buy, define the likely holding period. Honestly, before you celebrate the deductions, understand the recapture path. Before you approve a cost segregation study, model the back-end character consequences, not merely the front-end savings. Before you assume you can exchange later, learn the rules now, not after a sale contract has already handed you the proceeds. Before you talk about taking chips off the table, understand whether selling actually improves your after tax position or simply gives the government its long-delayed chance to settle the account before you put property into a structure because someone online told you it sounded smart. Understand exactly how that structure affects ownership, transfer, distribution, and recognition. And before you call real estate tax efficient, decide whether you mean truly efficient across the full life of the asset or merely flattering in year one. That last distinction is where adults begin. I have always believed that the intelligent investor's job is not to chase whatever looks clever in a single season. It is to build something durable enough that the passage of time works for him instead of against him. Real estate can do that. It can produce cash flow. It can absorb inflation. It can provide leverage under the right conditions. It can create wonderful long-term compounding. It can even create remarkable tax outcomes. But it only does those things for people who understand that tax strategy is not a collection of tricks. It is a sequence, a system, a long memory. And if you are going to step into that system in the next 5 years, I want you to step in with clear eyes. Do not envy the investor who seems to win every year on paper. Study whether he has built an exit that keeps the paper from turning into a trap. Do not ask only what a property saves this year. Ask what it costs when the entire story is finally told. Do not confuse a deduction with a victory. A deduction without a plan is just delayed exposure. Do not confuse activity with intelligence. Buying faster, borrowing bigger, and depreciating harder are not the same thing as getting richer after tax. And do not let the emotional power of real estate distract you from the mathematics of real estate. A house can feel permanent. A tax bill can feel distant. That is exactly why people make these mistakes. The visible asset captures their imagination. The invisible trigger escapes their attention. Then one day they sell or transfer or unwind or distribute. And suddenly the invisible thing becomes the only thing in the room. I want a better ending for you than that. I want you to own property with an exit already designed. I want you to understand the full life cycle before you sign the first document. I want you to know whether you are buying for income, for appreciation, for deferral, for long-term family transfer, or for some mix of those goals. I want you to know whether your strategy depends on exchange, on indefinite hold, on fresh capital deployment, on eventual debt paydown, or on all of the above. In other words, I want you to think like an owner of capital, not merely a buyer of property. Because once you make that identity shift, the tax code stops surprising you. And that is one of the great hidden advantages in investing. The winners are not always the ones with the best deal. Very often they are the ones who already knew where the danger was buried. So let me leave you with a final test. If your entire real estate tax strategy depends on what happens in the year you buy, you do not have a strategy. If your confidence vanishes the moment someone asks you about adjusted basis, recapture, exchange mechanics, or your exit plan, you do not have a strategy. If you are counting paper savings today without knowing who pays, when they pay, and at what rate they pay when the story ends, you do not have a strategy. You have a temporary feeling. And temporary feelings have emptied more pockets than bad properties ever did. The serious investor does not merely ask whether a property will go up. He asks whether the structure around that property will still make sense when he wants liquidity, when the market changes, when tax rules bite, when family planning matters, when he needs to transfer wealth. And when the government finally asks to reconcile the full history of what he claimed, that is the test. Not whether the property flatters your spreadsheet on day one, whether the full machine still serves you on the day you most need clarity. That is where real wealth lives. And if you are buying in the next 5 years, that is the standard I would ask you to hold yourself to before you buy anything at all.